Good day, everyone. Ali Safi here from Safi Financial Network, and we are coming up for the roadmap of 2024. First disclaimer I just want to mention before we are getting started to this roadmap is we are not forecasting. This is not a guarantee that all analysis are getting through in 2024. And make sure watch the previous analysis or forecast for 2023, because if you see this one, which I just put a link here up there, you will understand what was my forecast, a roadmap for 2023. And that was pretty spot on. I don't want to bring any snapshots or anything like that. So make sure watch that video and see what was my expectation, what was my analysis, and what was the principle behind that. And if you're just coming the same thing almost but a couple more charts, I'm gonna add this one. So that's why I'm coming with two videos, because in one video is going to be very, very long and everyone just getting bored. So I would rather to provide materials forecast for 2024 in two videos. So this is the first episode. I'm gonna come up with the next episode as well, which is gonna be the final one. But before understanding the episode two, you need to understand the principle behind that. So I'm coming with different slides in this episode, and make your mind and brain ready for the next one, or for episode two, which is gonna be the roadmap in 2024. So without watching this, you can't understand why I'm coming with the same analysis as I did for 2023 for the next episode for 2024. So make sure watch this video completely, and also make sure watch 2023 forecast completely to understand where I'm coming from. So where my analysis are coming from and how we are seeing the charts and how we are position ourselves for 2024. All right, so before any ado, let's get into this. So this is the first slide of the yield curve, basically. So the blue line is yield curve, and the orange line is S&P 500. As you see here, we are kind of like inverted for the yield curve. It's been a while right now. So if you see here in 2001, 2000, 2001, and here is 2007 to 2008, whenever we get below this zero line or 0%, so this means yield curve is inverted. And it's just short, just the explanation of inverted yield curve means bond for 2000, well, basically the efficiency or kind of like a performance for a short-term bond is outperforming the long-term bond. So, which is not suitable for the market. Basically, in a normal situation or normal economy situation, bond market, like a 30 years bond market or 10 years bond market, outperforming 3 years bond market, just because everyone is optimist for economy and everyone is piling into the 30-year or 30-year bond. So that's why efficiency or performance of the 30-year or 30-year is going to be better than 3 years. But in a normal situation, when people are thinking about a recession ahead or a shake economy, they just think short term. So that's how 3 years bond is outperforming 10 years and 30 years. So this means people would like to invest in short-term bond rather than long-term bond, just because they think that the economy is shaking. So that's how we get inverted yield curve. And whenever we get inverted yield curve, basically market goes to recession. It's kind of like early signal for the market. And we had this in 2000, 2008, which is a 207. So yield curve just inverted in 2006. In this case, yield curve just getting inverted in 2000, actually 2000, just prior the market top. And you see that here just S&P topped after like basically 6 months to 2 years after. And here is the COVID crash. As soon as we touched it, rebounded, and sure enough, just 6 months after that, because this happens in September 2019, and in February 2020, the market just crashed to the downside. And it's been a while right now in 2000, I would say 2022 and 2021. Uh, Yield curve just inverted, and it's kind of like one of the deepest inverted situation for a while, like since 20 years, even it goes below this level, which is a 2000. So as you see here, it's pretty inverted. It is very, very bad for the economy overall, but you see that market just first shake out in 2022, but rebound very, very nicely, and we are kind of like a close to new all-time high, or kind of like a double top. So based on this information, I should say, when yield curve is getting to uninverted and it's getting above this, basically when this happens, market is topped. When this happens, market is topped, and we are just getting into recession. So still, we have time to get there to the zero line, but when we get there, probably we will see a sharp decline in S&P 500 and the other indexes. So that's the first thing that we should just be careful about and keep an eye on this. We are not there yet, but when we get to a zero line or even above zero line, so this means we are pretty close to the top of the market. So just be careful on this one. So this is coming, but not coming in next day or so, or even next month. Probably in second half of 2024, we should be worried about this one. But it can happen sooner as well. So we don't know exactly what's the time, but this is a good leading indicator for us. All right. So the next slide is market breadth. So market breadth is the average of the stocks in S&P 500 when they are above a 200 moving average. So, for example, S&P 500 is include actually concluding 500 stocks, 500 different companies. So when they are getting above a 200 moving average, daily moving average, they are this means that market is just going to the upside nicely. And whenever we get to the extreme level, to kind of like this area, we should just be careful about this. So as you see here, for example, this is the top of the market in 2021, when the number of stocks above 200 moving average is getting higher and higher. Basically, the majority of the S&P 500 is getting close above like a 200 moving average. So whenever everything is good, market usually at the top, or whenever everything is bad, like this is a market bottom and COVID crash. So most of the stocks are getting below 200 moving average, which is very, very bad. And whenever we get there, so basically market is pretty close to the bottom. And here is, for example, June and also September, October 2022, which market just bottom in October 22. So a market rebounded pretty nicely. So that, as you see here, when we are getting to this green area, so this means market is very, very bad, and we are pretty close to the buying opportunity, a pretty good buying opportunity. And when we are getting to this top area, we should be very, very careful about the selling opportunities. So be careful about this. And also in this long cycle, we should see some kind of like a small cycle as well. So here is the intermediate, I should say cycle top here, intermediate bottom here. Intermediate top is January top, followed by 2 months correction. So if you remember, beginning of this year, January, February, and also March, was kind of like a shaky for the market. But after that, market just spike up pretty nicely to the upside all the way to July. So July market topped, and we got into 3 months corrective move to the downside. Right now, we just got back where July was. So that's pretty important to just keep an eye. It doesn't mean that market is gonna correct tomorrow or next week, but we should just keep an eye on this. I believe that market for January and also probably middle of February, we will see a decent correction. for the market, and we will get to those charts as well. But for the forecast, but right now I should say still we are in Santa Claus rally. So you will see this video. Actually, it's recorded just a week earlier, but you will see this when we are in kind of like in holiday for the New Year. So you will see this analysis on Saturday, December 31st or 30th, and 31st, the next episode, which is going to be tomorrow. So again, these two episodes are going to be very, very comprehensive. So make sure see completely both, and you will understand where are we coming from, or where are we at. So right now, we should just be careful about the January, February top, and this is going to be an intermediate cycle. We should see some kind of like a pullback for the next buying opportunity. So the first 2 months of 2024 could be challenging month for the market as well. So based on this cycle, I should say, yes, we are at intermediate top for the market based on the market breadth. The next slide is going to be just different dynamics, which is going to be global liquidity index. So this is kind of like a bullish one. Apologies for the quality. So this is the best quality that I can get. But this means the global liquidity index, we are pretty low, like one of the lowest one in the history. And whenever we get there, market is pretty close to the bottom for a nice move to the upside. Why? Because liquidity is coming to the market pretty sharply after this. So we should see in 2024, probably Federal Reserve is going to cut the rate, which is in the media, by the way. So everyone is aware of this. So that means liquidity is pouring to the market. And market, it's going to be a very, very bullish sign for the market. So this is going to be a bullish sign for the market. And for the next slide is going to be central bank easing. And as you see here, we are kind of like at the beginning of another quantitative easing by central banks. So we were at the top here in 2021, and this is kind of like a 2016. And as you see here, whenever we get there, market is getting to the correction just because quantitative tightening is coming. But this is kind of like a beginning of the quantitative easing. And whenever we get there, market is going to the upside just because money inflows are coming to the market and pouring to the market. So this is very, very interesting to see. These two charts are telling us liquidity is coming from the banks, from the institution, and that could be a bullish sign for the market. The next slide is going to be just the global liquidity index, a long-term one, which is 5 to 6 years cycle. And as you see here, this orange line, dotted line, is going to be a future cycle, and the solid black one is the current one. And as you see here, we are just here. So this means in 2024 and 2025, we should see some kind of like a liquidity is coming to the market, and that is pretty bullish. Like we should see some kind of like a moving forward. We should see some kind of like an upside move for the market. So that is pretty interesting as well. So based on the liquidity, I should say we should expect more liquidity, and whenever we get more liquidity, market is in a bullish momentum. So the next slide is this chart, which is NDX compared to Russell 2000. And that is very, very interesting because whenever NDX is getting at the top, Russell usually outperform the NDX. And as you see here, Russell just in December time and also in November as well, outperform S&P and also outperform Nasdaq pretty nicely. So this means the outperform is still ongoing, and probably this ended up to this level, which is going to be kind of like a July to October. So still, we should see some kind of like a bullish momentum for Russell 2000, while Nasdaq is kind of like underperforming. And this is based on the cycle, and cycle based on the trough. And as you see here, here's the top, here's the top, and we are just getting down, and the next top is exactly coming here. And as you see here, Nasdaq is coming down. So this means for the next 6 months, probably money is coming out of the Nasdaq and going to small caps, which is overall bullish for the market. And we should see some kind of like a sector rotation in different indexes. So if you are investing in heavy tech, giant tech companies, uh, for sure you are in profit right now. So make sure just to book some profit. And that's going to be kind of like a good strategy to book some profit out there and rebalance your portfolio into small caps or even some other heavy value stocks in S&P 500 or Dow Jones, just because Nasdaq is kind of like a potential for underperforming, while Russell 2000 is potentially is going to outperform the market and the other companies. I'm not saying those Russell companies are good companies. There are some of them, actually, most of them are zombie companies, and they're just at the brink of the bankruptcy. But based on this chart, I should say Russell can outperform NASDAQ for the next at least 3 to 6 months. So just be careful on this one as well. The next slide is Nasdaq to S&P 500. So this one is better, but still this is kind of like a shaky. As you see here, this is kind of like an ending diagonal, and this ending diagonal is forming at very, very important pivotal point. So in 2021 and also 2022, we see some kind of like a top information here. So the major bear market actually booster for 2022 was for Nasdaq. If you remember, Nasdaq just went down more than 30%. And this is very, very obvious that when Nasdaq is going down, big giant companies, tech companies are just bringing the Nasdaq down while S&P is doing better. So right now we are at the top and forming one of the bearish pattern here, which is kind of like an ending diagonal pattern. So if this one break down to the downside, I should say, so everyone needs to keep an eye on this. If this one break down, we should see some kind of like a fragile or kind of like a decent correction for NASDAQ. And this one can go easily down. I'm not sure for this level, but I think this is going to be a good level here. So we should see some kind of like a downside for Nasdaq. So based on these two charts, I should say Nasdaq is outperforming right now the other indexes, but probably it's going to be at the end, and money is coming out of Nasdaq and big tech companies, and probably this one is going to the other sectors, which is going to be different names and sectors for Dow Jones and also S&P and Russell. All right. The next slide is SPY to TLT. So SPY is S&P 500 ETF, and TLT is kind of like a treasury ETF. And as you see here, since 2020, S&P 500 stock market just outperformed the bar market fantastically. And this is kind of like the parabolic phase to the upside. As you see here, this is pretty nice moving forward to the upside. But from here, which is going to be April 2023, just the stock outperformed nicely bond to the upside. And this is like a 45 degree to the upside. So this 45 means we can see some kind of like a pullback in the stock market. And also we can see kind of like an outperformance of S&P of treasuries, which is TLT, which is coming through as well, because as you know, yield is going to come down, and when yield is down, treasury is going to be beneficiary of this, and treasury is going to outperform the S&P 500. So I would say, based on this, treasury can go down nicely, can go up nicely, while the stock is just doing sideways or even downside moves. So that is very, very important. The next one is XLY compared to XLP, which is consumer discretionary compared to consumer staples. So whenever consumer discretionary outperform the staples, this means we should see some good movement for the Nasdaq and also the other indexes. While this one is going up nicely, um, we are just heading to this supply area. So this supply area is very, very important just because, especially this one, this shooting star at the top means we are kind of like a close at the top information for consumer discretionary at a very, very critical level. So this is very, very important just because whenever we see this, we should see some kind of like a correction in some kind of like a stocks, especially Nasdaq area. So as I said before, these charts are telling us we should just expect still money is there, but sector rotation is coming for the market. And usually when sector rotation is coming, one sector is going to underperform while the other sectors are going to outperform. And right now, I should say Nasdaq and consumer discretionary is going to go down, while consumer staples are going to outperform the market. So that is very, very nice as well. So based on these charts, I should say the last one, which is going to be fruit of this chart, is a 17-year cycle. I'm going to cover this a lot in next episode for the cycles, but this is just the beginning and introductory chart for the next episode. And make sure watch the next episode because the fruit of this analysis coming next episode. But this is just for a sample. So this is 17 years chart or 17 year cycle. And based on 17 year cycle, we are kind of like a pretty close at the top of the market. As you see here, just 17 years back, from 2024, if you go 17 years back, you ended up to 2006 to 2007, which is very, very important. But we are not there yet. So as you see here, 2007 market just topped. So we are just at the beginning of this 17-year cycle. And we should see some kind of like good momentum at the beginning of this year. I mean, at the beginning, at least first half of this year to the upside. But when we are getting to the second half of 2024, I should say everyone needs to be cautious because I believe market is going to just start going up and then coming down sharply. Why? Make sure watch the next video because next video I'm going to put more materials and put more charts on that one, and you will see how market is doing well based on the first half, based on the different cycles, and how market is going to probably rotating to the downside based on the cycles for the different years that I'm going to bring up for the next episode. All right, so make sure watch that one as well. I believe this one covered the first video, and the next episode is coming tomorrow. This is episode 1. Ali Safi, over for now. Have a fantastic evening. See you on the chart. Bye-bye.